Hey, I'm watching Tom Bilyeu's video. I'm actually surprised that he has so limited amount of knowledge for investing and so wrong knowledge. If you don't know Tom, he has sold his guest nutrition brand for 1 billion. He's super smart guy, but sometimes when you are super smart, it's also easy to just think different ways of different ways that supports your own ideas. And that's actually just something I learned from the famous book Thinking Fast and Slow. So you need to be very careful when you are smart. But let's check his video.
Is like, well, you dip below the liquidation point for a millisecond. Tough. It triggers a cascade of events where you get wiped out. And so that's how the red just tumbles and it keeps getting worse and worse and worse and worse and worse until basically everybody's liquidated and then it stabilizes again. But then that's a lot of people that just got, in some cases, lost their entire net worth.
That's why you should never trade using leverage. Never. And none of the richest investors in history, or very rarely, or very, limited amount of their investing returns has come using leverage.
So out of that 1.5 trillion, these are actual portfolio accounts and things that are kind of like this is why as I tried to wrap my head around the stock market, it always pissed people off. But I would say, wait, this is like trading baseball cards. That was my first understanding of it in my 20s. And everyone laughed at me. Ah, ha, ha, ha.
Yeah, because he's wrong. It's not like trading baseball cards.
And now, the more I learn about it, it's like that curve. It's like idiot says this is like baseball cards. Guy in the middle is like, you don't understand how sophisticated this is. And then the guy that actually understands it's like, this is like trading baseball cards. Yeah, I've gone on that journey. This is like trading.
No. And this is sometimes annoying. When you are super smart, you don't even think you might be wrong at any point. And if he has had this opinion since what he said, since he was a child, teenager, that means he hasn't learned anything since he was a teen. But let's continue. I will explain later.
Baseball cards. This is a casino. They are only worth what people say they're worth. Even something that pays dividends can trade below what you would make just collecting the money off the dividends. Doesn't matter.
Of course.
It only trades at the price people are willing to pay. That means this is a psychological game. That means you are gambling on what the emotional state of people is going to be. Period. End of story. Anyone that says any different than that is fucking lying to you.
No, and that's like he's using the F word, which he rarely uses. So he has very strong opinion for this, but no. Over the short term, sure, it's a psychological game. Of course it is. Over the short term, any stock can go plus 50%, minus 50%, and the actual company never would go plus 50 or minus 50, the value of the company, over the short term. But also, if the company you are buying is the price of the company is below the dividends they are paying, and you check the company, you check the financials, you check the future of the company, and there is just some, things that people has misunderstood, which is rarely the case, but it might. Every now and then you will find those companies that people are, for some reason, so afraid for no reason. It will be your best investment ever. Remember, Tom is now only talking about the price of the stock. The price of the stock should be last thing you look when you are investing. First is, what is the value of the company? What is the value, underlying value? What are you, if you owned the company, what would you get? And if it's amazing company, then check what is the price and what is the price you would be willing to pay for this value. But he's talking price first all the time. He never mentioned in this video about the actual value of the stock. And of course it's like trading baseball cards. If you are never even looking for this company, you are looking at the stock. You are looking at the stock like it's a fucking computer game. Of course you will not see the value, and of course you think it's like baseball cards. Remember, over the long term, the stock price will always be correlated for the earnings you get. Over the short term, sure, the market can be crazy, but over the long term, it's always based on the value. And if you are able to buy something that is now in the short term lows, but the value is there, then it's something you should buy. But let's continue.
Or they just don't understand it, which I don't get.
They're lying to themselves based off the story that somebody else told them.
Correct. Now, the stock market has huge advantages. It's good. It's amazing. Debt has huge advantages.
That's
it's
right.
good.
That's
it's
what I'm
amazing.
saying. Yeah.
But oh my God, this stuff becomes a problem.
The Japanese bond market breaks. U.S. stocks are going to take a tumble. Is the S&P 500 dead? Should we go to gold? I have 6 months of cash in my bank account. Should I leave that in there? Should I move it?
I will walk people through the way to think about it, the mental framework. I'll tell you what I'm doing. I do not advise people to attach their boat to my way of thinking. They need to formulate their own way of thinking. That way we don't both get wiped out should I be making poor decisions. But it goes like this. So what do we do in a time where countries don't trust each other? So the world order is unstable. I don't know who's going to be friends today and who's going to be friends tomorrow. I don't know if people are going to war. I don't know what that's going to do. I don't trust people to pay back their debt. So you start setting the table like that. And you go, okay, well, in times of massive uncertainty, what are the usual plays? One, recognize with massive humility that you cannot predict the future well. So you want to have a diversified portfolio that diversifies across economic forces. So what are the economic forces? You've got things like high risk. So when you've got high risk, you've got a lot of volatility. That's going to be the area that pulls back first. That's why you see these lightning crap.
High risk. Yeah, again, here is a problem. Again, you will find zero of the great investors talking about high risk and that it is the volatility. Sure, on literature, it's about volatility, but it's really not. If you have an amazing if your own company is trading in the stock market, and your company is trading plus 30, minus 30, plus 30, it's super volatile. So it's high risk. But if you know that your clients are paying, you know how much new clients you are getting each week, you know what are your costs, is there really risk? You know you will have better and better returns each year. Is there really a risk? No. That's why when you are investing, you should always have an owner's mindset. What if I bought the whole company? What would I buy? That's the mindset. And diversifying through everything, then just invest in the index. If you are diversifying too much, you are just going towards the average returns of the market, and then you just, should invest for the average returns of the market. If you want to invest in stocks, you need to know the company, and again, company so well that you would be happy to invest in that company only, for the one company. You would not be afraid of having one company in your portfolio. For example, this year. And then next year, you find other company. Now you have two companies in the portfolio. In the same way, if you owned a company, you are not going to start building two companies just, I have one company, it's huge risk. No, then you don't know your investment that well.
In the price of the stock market in a way that you're probably not going to see in something like gold. Gold typically isn't going to go up super fast. It's not going to go down super fast, not by huge swings. Because what gold has shown over time is in times of uncertainty, people go there not because they expect a massive return. They go there to protect themselves against inflation. And so they're just moving to that saying, this is where you park your money when you're like, I don't know what the fuck's going to happen. So it is as close to I'm going to bury my money in the backyard as you're going to get. But I want to bury my money in the backyard in a way that it can't be inflated away. So
by the way, company is so expensive currently that, it might not go down, but it would not be a surprise if it went minus 50%. Again, it might not, but there is a chance for that. And honestly, I'm not willing to take a risk of something going minus 50% in order of getting the inflation returns for the next 10 years. Just then don't invest. Then just wait with cash. Again, cash will cost you a lot of money over the long term. Over the few years, it might not. or then just invest in the index.
Cool. Gold has been that forever. Bitcoin is trying to be that. Bitcoin trades more like a tech stock right now, but I think that it's got long-term legs, but that's a me thing. So people need to be thoughtful. They need to formulate their own opinion about what they think about how the human mind.
By the way, here, he's so over-analyzing everything, like Bitcoin, for example. I know there is probably a lot of people who are investing currently in Bitcoin, but you don't know where Bitcoin will be in the next 2 years, in the next 3 years, 5 years, 10 years. And that's the whole point of me making this video. Why Warren Buffett is the greatest investor of all time. Why, I don't know, the one up on Wall Street guy. Why Charlie Munger? Why Monish Pabrai? Why Sven Carlin? Why are they all getting huge returns over the long term? Because they are investing in something they are pretty as close to, certain as you can be what the returns are going to be. But here you just don't know. And the same thing, people are saying that Warren Buffett is an dinosaur and he doesn't understand Bitcoin. But did you know that Warren Buffett doesn't like gold either? And why? Because gold doesn't have intrinsic value, or it has. And if it traded in its intrinsic value of how much people are actually using gold, it would go something like 75% down, 80% down. So, and the Bitcoin, same there. It would not really matter if it was 100,000 or 50,000 or 20,000. So it's like, and for companies, he told the company has a high risk. It might go below what it's paying for dividends. Great, amazing. Find me companies that are paying more dividends than the price of the company, or the liquidification value of the company is higher than the current price. Fucking find me those companies and I will invest in them immediately. If of course they have good future prospects. So, I don't know.
Is going to react to Bitcoin. I have a thing that says the world is only getting more technical. When you start thinking about wanting AI to be able to do whatever the hell you want it to do, you're going to give it digital money. You don't want that digital money to be owned by the government. I think everybody sees now, people alive today will see how rapidly a government can become unstable. Mm-hmm. And so I think they're going to go, don't want anything controlled by the government. Government has a history of seizing gold. When protesters started getting shot in Iran, the price of Bitcoin went skyrocketing there because they just started gobbling up as much as.
By the way, sure, he's correct in the price of Bitcoin stuff. But again, Bitcoin needs to change in order for it to be, in order for normal people, in order that normal people would start happily using it. It's honestly little too complicated for any normal people who would, like to use it. And also, normal people are not thinking about this. You who are watching this video, you are thinking. Normal person, he's not thinking about it. So it's anyways 95%, 99% of the people who would even not think about investing in Bitcoin. Not now, not in 10 years, not in 20 years. So, but let's go.
They could. And so it's like, prices aren't local. They started buying rapidly there.
It outdid the local currency.
Right. Yeah. So I think people will look at that and go, this is decentralized. I like that. It's far easier to move than physical gold. That's my beef with physical gold. Also, I feel like I can quote unquote see it. Whereas gold, I'm just taking somebody's word. No, you really do have physical gold, Tom. It's all good. So I'm like, So anyway, you start doing that. So my portfolio looks like I still own quite a bit of debt, but it's all extraordinarily short term. It's all U.S. debt primarily, though I do have some corporate, but I've been slowly backing out of that for the last year. The reason there is that I know that they'll at least print money to cover that. Mm-hmm. And so at least U.S. government debt is saying every holder of dollars will suffer as Tom suffers. So I'm like, okay, like there's some balancing thing there. But I am going to be migrating more and more out of that into things like gold mining stocks, silver mining stocks, Bitcoin.
Going gold and gold mining stocks currently are a horrible idea. Gold is so expensive, and the valuation of gold and gold mining stocks, it's bad idea. Currently, gold miners are doing amazing. And when something is doing amazing, it's not good idea to invest in those. That's why you should follow like 50 different companies in different areas in your in your like Excel sheet or anywhere. So you will see every now and then one of those 50 companies will be for some reason in, huge dip, then you would actually be able to buy it. For example, oil stocks. Oil currently has went down a lot, but it's not down enough for me to think that, okay, now it's good investments. When it's, I don't know, in 50s, when it's in 50s, it might be a good investment. Currently, it's still not good enough. And for gold is high. It's you will never want to buy anything in the all-time highs. And especially gold, what is not correlated in any, intrinsic valuation. So let's go.
I'm already massively deployed. ETH, I'm already massively deployed, but I might start picking up some more there. International exchanges, so that I'm still in risk on markets, because I think that's important, because you don't want to miss out on something that goes up, because again, I don't think I can see the future clearly.
Yeah, that's true.
In the US, just not overly indexed.
That's true, yeah. Let's stop the video, yeah. He's correct in that staying in cash is not the best idea. And by the way, why Warren Buffett currently is 50% cash, when it's just different for him. When he's deploying money, he needs to deploy a lot. And in order to find companies that moves a needle, there is not many companies that would move a needle for him. So he needs to wait. He just doesn't have the opportunities. But for a normal person who can invest in any stock there is, you will find great stocks to invest in, great companies to invest in. And also one thing I don't like, that he's talking about diversifying across every fucking thing. That makes everything too complicated and your returns too bad. You need to invest. If you are picking stocks, pick stocks in the areas you know well. If you know construction industry, search 1,000, 10,000, 50,000 companies in construction industry. If you are a swimmer, search swimming stocks, or nutrition, sports stocks. If you are investing in company you know so well that you would able to run the company yourself, and you will see that it's undervalued, then it's a great investment. It's no use for you to start trying to diversify across everything, because then again, just invest in the market. And if the market is too high, then buy and put option with couple percent of your portfolio, 5% of your portfolio, which would mean if the market goes up 20% next year, you would go only up 15%. But if the market goes down 50%, you would go down zero almost. Again, put options over the long term, it's a horrible idea. But when the index valuation for the S&P 500, only if it returned to the mean, it would be something like minus 50%. And even if we are in the new normal levels, which everyone is talking about, okay, if we are in the new normal highs, okay, we might not go down to the old lows. But is it possible that we would go down at least to the average? That the bottom of current stock market valuations, PE ratio, would be average of historical? Would be stupid to think that it would not. So, I don't know. Find someone better. For example, Sven Karlin, to find investment ideas. Tom is great when it comes to different world order stuff, and he's great. I love his channel. But in investing, not that good. By the way, while I was editing the video and eating, I saw interesting things when I went to look at the gold price, because I started to think about Tom's thing about now buying gold and gold miners. It's been up 100% per year. That's crazy. And remember, when a thing is going up like a rocket, it's not good sign for your long-term returns. So it would, if anything, it would be time to go out of gold. And let's look, it's like 2011 gold was, the price was 2000. And in 2023, it was back in 2000. So that's 12 years of zero returns and not taking the inflation into the account. So that's like 13, 14 years of actual zero returns. So be very careful with these ones and the tips you are getting to the. Remember, even though you should always look at the value of what you are buying, the point of the price is also super important. We have gone from gold price in 2022 1.6k to now 5.5k. Do you actually think it's going to stay and you are going to get great returns with current prices? Or are you even going to have positive returns with current prices?